That's a really dirty screen. I'm surprised you're okay with that. Hey, good afternoon, everyone. My name is Chris Lopez, and I have got Charles Roberts here with me. So what we're doing today is we're doing our July Roundup webinar for Denver real estate investing. So, like I said, my name is Chris. I am a real estate agent here at Your Castle, and Charles is a real estate agent and successful investor, and also the president of Your Castle Real Estate. So this is our monthly roundup where it's our quote-unquote virtual cup of coffee. And it's just meant where we can go through some quick market stats, go through a couple of recent deals, discuss it so you can keep your finger on the pulse of the Denver real estate market. So Charles, how are you?
I'm great. Thanks, Chris.
And just as a reminder, we love questions. We do these webinars live, and then we take the audio and post it to the podcast channel. So if you got questions while we're doing this, definitely post in the chat. We will be answering them in real time. And if you can't make the next live webinar, check out our podcast. Just search for the Denver Real Estate Investing Podcast. And actually, before we jump into the market stats for the month, there's some really exciting news. So Your Castle, and Charles is one of the main authors on there, they just released the 5th edition of the Practical Guide to Colorado Real Estate Investing. So Charles, tell us about this book.
So we started as investors. It never occurred to us we'd ever be real estate agents or build a company. We were investors, and we got our license and found that people actually wanted to work with us, much to our surprise as agents. So a couple of years after we did that, we started writing a book. We just thought it would be really neat to take our experiences, and we wrote the first edition of the Colorado Real Estate Investing book, Practical Guide to Colorado Real Estate Investing, in 2009. And it was the first book we had ever written. I think we were at like 10 or 11 right now. And it was just our thoughts on what we had done to build portfolios, to do fix and flips, the analyses we went through, and we put it all in one place. And we are now on our 5th edition, and we just updated it. And I'm happy to announce that Chris wrote chapter 8. He actually wrote a whole new chapter on house hacking, which is going to be a subject that we're going to be talking about today, which is a really, really relevant subject in our market. And as you can imagine, what we're talking about in 2009, some of it is relevant and some of it isn't so relevant anymore. We don't do a lot of short sales and bank-owned properties anymore. But guess what? In 5 or 8 or 10 years, we're going to be back to that. But the house hacking is something that we wanted to include, and Chris is an expert on that, and that's chapter 8.
Yeah, and I had a lot of fun writing it. So, Charles, how much does the book cost?
It's basically free. I mean, we actually have it for sale, but for us, it's just like our classes. It's like these podcasts. How much are you paying for this podcast, this webinar? Nothing, because we want to get our message out there. It's a great opportunity for us to talk to people, and the book is the same way. Just come and chat with us, and happy to give you a book.
Yeah, so I mean, if you ever come to Your Castle classes, you can grab a copy. We will have an updated ebook version on the website very soon. I've got a few more things I need to do. You can also download it on there. So let's jump into the market snapshot. I'm going to pull these up. And you know what's going on with the market, Charles. This is something that you are known for around Denver about giving your real estate trends class on the Denver market. So these stats are for June. We'll compare them from June of 18 to June of 17. So Charles, give us a rundown.
Okay, well, let's look at a couple of these. I know some of you are listening and some of you can see, but home sales, for example, home sales in June of 18, there were 5,824 home sales, down 5% from a year ago. This is one of the most interesting things that is going on in our market, is the number of closings is actually going down. And let me talk a little bit more about it, because normally you would think that in a market with appreciating prices, people would start selling their properties and you'd have this boom where you'd have lots of people buying and selling. That is what we have seen in previous generations of real estate. But that's clearly not what has happened the last few years. And this past year over year, June of 18 over June 17, is just another example. We're actually selling fewer properties. And if you're reading the national press and looking at Zillow and others, you'll see that you are now hearing this nationally. So Denver has been a couple of years ahead of the market. It was ahead in the downturn in 07, 08, and it was ahead coming out of it. For several years now, our inventory has been excruciatingly low, and the number of sales have gone down, and that really has been what's been pushing the prices up. And you're seeing nationally the same environment. That's what's happening. So that's one of the big things that we talk about. New listings, for example, is down 3% year over year. Under contracts up only 2%. And let's not forget that we're growing. We're the Denver metro area, the Front Range, is growing in population, but people aren't buying many homes simply because there's so little inventory. And that's what we think, and we're pretty sure of this, that's what's keeping the prices up and supporting our prices. And if we go to that right now, up another 8.5% June of 18 over June of 17. So those are a couple of the big takeaways: is a continued lack of inventory, more buyers than sellers. Supply and demand means that the prices have continued to go up.
And so, I mean, hearing you and looking at the stats, it's basically sounds like what's been going on the last couple months and couple years.
Years. I mean, like literally 5, 6, 7 years. I'll tell you one interesting stat that I don't really think I'd paid attention to before. In terms of the days on market, the median number of days on market in Metro Denver is 7. That means that as many properties that come on the market go under contract in 7 or fewer days as more than 7.
So wait, sorry, say that again. Back up.
So the average days on market is 20, which is very fast. But that takes into consideration some properties that just never sell, been on the market for 200 days. So the average gets expanded. What this means is, with the median number being 7, that means that a property being put on the market, half of them will be under contract within a week, and the other half will be sometime more than a week.
So you're talking about the average versus the median.
Exactly. And normally, and a lot of times, there's not much of a difference, and people sort of get confused and they think that they're really smart because they know one or the other. This is a case, though, that's actually really interesting, that 50% of the properties put on the market go under contract within 7 days. That's the easy way to think about that.
That is just a mind-blowing stat.
Yeah, it's really cool.
Quick, but yep. I mean, we put offers in, and
I know, and we suffer. And you, if you're listening and you're watching right now, I mean, you're living this because we're living it too. It's still a very, very strong market, and refer back to podcast a year ago, and class 2 years ago, and webinar 3 years ago. It's been going on for a long time, and we're just not seeing any signs of it letting up anytime soon.
All right, so moving on to the next segment. It's a brief segment, and this is actually an email that Lon Welsh, who also runs Your Cast Real Estate, sent a very interesting email, I thought, a few weeks ago, talking about household formation. And I mean, I am not an expert on this topic. Charles, are you intimately familiar with data, or should I just kind of read a paragraph from Lon's email?
Yeah, why don't you actually read a paragraph so people are hearing this?
So household formation is a very important driver for the real estate market. When your teenager lives in your basement, that is one household, and your family consumes one housing unit. Now, when your teenager gets a job and moves out, you have created a new household, and the entire family consumes one more unit of housing. In a recession, your teen loses their job, abandons their apartment, and moves back with you. That destroys one, and destroys is in air quotes, destroys one household unit. And some landlord now has a vacant unit.
Exactly.
And just to kind of continue on, so in economic expansions, the need for housing, so rental units plus owned units, expands faster than the population growth. In a recession, the economy destroys households while population growth usually still continues. And expansion always creates net lots of new households. A recession could either reduce or about break even, or even have a very slow positive growth. And so what this chart does here, I'm going to flip on to the next thing. And a lot of people are listening, so I'm just going to read this email, or the rest of this email, describe it. The chart shows that for the entire U.S., so this is not a Denver-specific chart or metric, but this is the entire U.S., we're creating new households at a fast pace. Given we have positive population growth as a country and unemployment is low, that average population, which is millennial heavy, prime age to have kids, our local economy is creating jobs faster than the national average. So we import workers from other states, which is one reason Colorado is growing in population. And all this household growth is absorbing lots of new rental units. And of course, keeping the resale market inventory very, very low. So describing this chart here, I mean, this is actually, as I'm realizing now, it's a hard chart to describe verbally, but it's showing a percent change in the household units. And it shows all the way back to 2004, and it's going up to like 2% in 2004, 2006 timeframe. It goes negative right around 2009, 2010. It's gone up, gone down, gone up, gone down. But now, if you look at the chart, for the past 15 years, we're at the highest bar on the chart. So we're at 2.5, and I think it's a 2.5% from the previous year. Mm-hmm. So that is 2.5 from the year before. So Charles, you're an expert on trends. You're an expert on market data. What does this mean?
What it means is, in the big picture, at this point in time, we're creating a lot of households, and those households need to live somewhere. And where they're living is a lot of rentals because there's so little inventory in the market to buy. And when there is inventory, like we just talked about, the typical property goes under contract in 7 or fewer days. So what you see if you're looking at this is that during boom times like 2004, 5, 6, there was a lot of household formation. People were actually creating more households, meaning more roofs. People were moving out and buying properties, and because it was relatively easy to buy properties because of the lending situation, more people did that. But it's gone up and down over time. It went down during the downturn. What happened during the downturn? People lost their houses. Kids moved back in with their parents. Parents moved back in with their kids, and it was very, very difficult. There was even a period of time where we literally were going down in the number of households, and that was tough. We went up in the 2012, and I'm going to guess that what was happening there was that it was a very, very affordable time to buy. So if you could get a loan, 2012, the prices were low and people actually went out and bought. And since then, it's gone up and down. And what we're seeing right now is because the economy is relatively good, that probably has a lot to do with why we're at an all-time or a 30-year, whatever it is, high of household formation. So always take stuff like this with a grain of salt. You would never listen to a podcast and say, oh, because of that statistic, I'm going to buy property, or I'm never going to buy property in Denver because of one statistic. This is just a fun way of looking at it, which helps me understand a little bit more of our market and understanding that over the course of a long period of time, right now, the Denver market is really strong. People are moving out of the basements of their parents. They're getting married. They're building families, and they're requiring more household formation in an environment where we're not building enough. Yeah. While we're building more than we did a few years ago, we're just clearly not keeping up with the demand.
And I just thought it was a really interesting stat, as you said, like this should not change your investing plan one way or the other. But I mean, I've been through numerous of your classes, one of those, Charles, on the Denver real estate market. I've not seen the household stat through around before. I actually never thought about that as a stat before. So my inner data geek just said, oh, that's kind of cool. So let's talk about it for a few minutes.
Yep.
So let's move on and talk about a couple of deals. Let me just check real fast for questions. All right. Very good. So the first deal we'll talk about is actually going to be a house hack. And we actually talked about this property on last month's webinar. And so, Charles, and what we're going to do now, we'll give you a really quick rundown on it because it was under contract when we talked about it. And now it's closed as of, I think, Thursday or Friday of last week.
5 days ago. Yep.
And so actually to run it through the house hacking spreadsheet that we put together and just play through some like what if scenarios just to show you that, hey, even in today's hot market, you can still find properties as a house hacker that makes sense today and that makes sense in the long-term wealth building process. And just to reinforce the point, if you're looking to get investing and you've not seriously looked at house hacking, you really need to. So Charles, give us just the 2-minute rundown on this property and why it looks so good from a house hacking standpoint.
Yeah, sure. So the clients were actually a couple that was house hacking already in a duplex. I think he had bought his duplex around 2012 or something like that.
Yeah, it was like the perfect time, 2011, 2012.
Yep, and living in one side, had tenants on the other, has built a lot of wealth from simply doing that, appreciation and cash flow, and want to do another one. So we've been looking for, 5 or 6 months. I mean, it's been a while. We actually had at least one under contract that fell through. We found this property in Aurora North. It just made a lot of sense. It was actually bought by a colleague of mine who I've known for 15 years, and he actually bought this, I think, for $80,000 in 2008, something like that, and has done really well with these and just wanted to start cashing out of some of his properties. So it just made sense. So what the couple is going to do, the buyers are going to do, is they're going to fix up the property somewhat, and they're going to live in the basement. Why? Because they're willing to live in the basement. You might not be willing to live in the basement. You, Chris, might not. I might not, but they are. And what they know is if they make some, living in the basement sacrifices for a few more years, they'll be able to acquire a couple more properties, putting a very limited amount, in this case, 5% down, and then ride that growth upwards. And you're going to go through the numbers, and it's really great stuff. And I'll tell you, Chris and I just talk about this all the time. Like, we just love working with people like this because it's a smart move. It really is. And you're going to see the numbers. They're basically going to be living for free. Actually, like, even with utilities, I think they're probably going to be making a little bit of money. They're living in a basement. They have people upstairs. They have tenants, but it worked for them. We're really excited about it.
And so actually, I saw a property last week, did a final walkthrough with them. So I got to see what the property is like. That was my first time seeing it. So, main floor upstairs, you got a kitchen, and it's actually, the kitchen has been recently remodeled. And it's one of the things it's a nice remodel, but they left a few things, there's no stove. There's a few things got to be fixed. It's one of those remodel jobs where it's like 90% done.
And it was either the stove or the fridge. Did I tell you? You might not even know this. They had bought, if there was no stove, it was probably the stove. They had actually bought a stove, and that was included in the contract. And they let us know about maybe a week before closing that somehow it was like Home Depot or something didn't deliver it. So we ended up taking money off for the stove or something. We got a credit for that.
Yeah. And I think there's, so living room, another could be another bedroom and office, then upstairs. A lot of options, the very upstairs. You can definitely have a couple more bedrooms up there if you wanted to. Then going down into the basement, there's a kitchenette down there. It's a full kitchen with they're going to have to put a fridge down there, but there's a stove, there's cabinets, and then there's 2 bedrooms down there plus a living room, as I recall. Got a backyard. And then at the very back of the house, there's a gigantic 4-car garage. And no one's parking their cars in the garage because the previous owner had been renting it out as a storage unit to, I think, another person in the neighborhood.
Kind of a neighbor, a guy. The story we got was it's an older guy, and his wife said, "Get your stuff out of here."
Yeah.
And so he started renting and really, really wanted it. So I hooked him up with the buyer, and he's paying $350 a month. And what was very cool is the numbers for this property made sense. We didn't even know we were getting. We thought it was the tenant stuff. And then we got an additional $350 a month. And believe me, that put us over the top.
So this one give you guys that paint that picture for you. So before we jump in the spreadsheet, so our house hacker is going to live in the basement. They'll rent the main floor part of the house, probably for about $1,700 a month is what we're expecting, plus $350 a month for the storage unit.
Yep.
So let me pull up the spreadsheet. There we go. Computer was being a little slow. So I'm going to do my best to describe this. I know if you're seeing a spreadsheet the first time, there's a lot going on there. But we're just looking at the typical spreadsheet you've seen that we've used 1,000 times from Joe Massey. So the final purchase price was $330, right, Charles?
Yes.
So $330 for the purchase price, and they actually put 5% down. So their initial investment was, just over $20,000.
Yep.
Mortgage interest rate, Andy, what it was? 4.5% for owner occupied?
It was 4 3/4. I'm pretty sure it's 4 3/4.
So if we're off by quarter point, it doesn't really change much in the long run. So in the monthly rental unit, what we're putting in here is the $1,700 they can get for the upstairs main floor, $350 for the back, and I did a very quick guesstimate for the basement. Probably being on the conservative side, they can rent it out for $900 a month. So we're assuming about $2,950 for the entire rental income when they move out of the property in a year or a couple years, so they can repeat the same process. Taxes were about $1,900 a year. We're guessing about $1,200 a year in property insurance. We put, the spreadsheets defaulting to $1,700 a year in repairs and maintenance. And since they're owner occupied, that probably be lower, but it's always good to have on there. No HOA, and we're actually including PMI in here since they're doing a 5% owner occupied down. And since it's below 20%, they have to do PMI, which is mortgage insurance. So I'm going to just jump over the summary table, which is just colossal table we have that talks about building wealth. And the whole idea here is that the model is built on you buy a property, live in it for 2 years, then buy a similar property, live in it for 2 years, and just repeat. So over 8 years, you get 4 properties. Now, for their situation, it's not entirely accurate because in 2011, 2012, they bought a duplex at around the perfect time in the world. And I remember talking to the gentleman, months ago now, and their plan was to buy another property in a couple of years, but the prices had risen so much since he bought that property in 2012. He wanted to sit on the sidelines, and then a couple of years went by, and he was like, "Oh man, it's just going up. I should have just bought a couple of years ago."
Yeah, who knew, right?
Yeah, so you know what? I'm young. Time's on my side. I just need to buy another property. So if you look at property 1 here, we're assuming that he's not going to make any money while he's living there because he's living for free. I mean, right. So, a dollar saved, as good as they want, $1.25 earned from taxes, so to speak, almost. Right. And the numbers actually work out because $1,700 for the upstairs, $350 for the downstairs, his mortgage payment and everything. What is that going to be here? Remember what his monthly mortgage payment is, Charles? I'm scrolling through the spreadsheet here. So. Yeah,
I actually calculated it, and I can if you want while you're doing it.
We said about $1,630 a month is what the spreadsheet says, which I'm sure is a ballpark close.
And that's PITI with taxes and insurance?
That is PITI, yes.
Okay.
So if he's, let's say $1,700 a month for convenience, and that's actually taking the PMI, actually, yeah, I'm sorry, that is just the annual payments for the mortgage insurance, for the mortgage. So about $1,650 a month, but he's renting out the top unit for $1,700 plus about $350 for the back end. So just over $2,000. Mm-hmm. Well, extra $300-$400 a month is going to cover repairs and maintenance, taxes, and utilities.
Right, and this doesn't include the write-off he's going to get for the mortgage.
No, it does not.
Right, so...
Speak on that for a minute.
So, his first, I think he got a 30-year, so I don't know, 5% or so of his first payment of his first PI principal interest payment that's about $1,600 will be tax deductible. So depending upon, how he does his taxes and deducts, et cetera, he might have, of course, a large deduction from that as well. So this is why you want a spreadsheet and want to talk to a professional CPA and all that kind of stuff, but it just keeps getting better. The point is, these folks are willing to live in a downstairs, in a basement for a couple of years because they believe, and we believe, that they're going to make a ton of money from this.
I mean, if I could go back in time and do it before I was married or before I had kids, this is the exact same thing I would be doing, just because the numbers just get unbelievably outrageous almost. Yeah. So going back to the spreadsheet here, so I know a lot of you guys can't see, and there's a ton of information on there, but we assume for the first year and 2 years, they're about breaking even. And in this case, that's actually what it looks like, plus or minus $100 a month. So really not a big deal in the grand scheme of things.
But living for free.
For free. So. I mean, they're not paying rent. They're not paying mortgage. They're living for free. Mm-hmm. Now, in 2 years, let's just say they move out and they find a similar property. When they move out, if they're able to rent out the place for the main floor, the downstairs, and that same guy still renting the storage unit, they'll be cash flowing about $10,000 a year from that one property, which, so what's that, $800 a month? Okay, that's not that much. That's not going to change your life, so to speak. But they put 5% down. This is where it gets crazy. Right. 5% down. Right. And they're putting 5% down, and they're able to control an asset that's, $300,000 to $400,000.
Right. So they put 20% down, they might be making $10,000. Right. So those numbers look really good.
Yeah. When you look at like the 5%
return
down.
Yeah.
Because we see a lot of times those numbers, if you put 20% down, you're making, $10,000, $12,000 in cash flow. They're putting 5% down. So that's the difference of $20,000 down versus like $60,000 or $70,000 down. Right. It's a lot of money. So if they go forward and buy a similar property, they buy this, a very similar property. And then I won't go through the numbers, but if they do that in year 3, then year 5, then year 7. So over the 8, 9, 10-year period, they buy similar properties. By the time they move out of property number 4 in year 9 or 10, their cash flow, this is all based off the assumptions we make and increasing rents and all that stuff, is over $50,000 a year in cash flow.
Wow.
That is, I mean, that's the salary.
It is.
That is a salary. And if they save the cash flow, continue to save money, they've got over $200,000 saved up, because we're assuming in this model that all the cash flow you're making from the property, you know what, you got discipline. You're saving that money, not going out to Vegas. And since you're not paying rent, since you're living for free, not paying a mortgage, you know what, that $1,000 you would spend, or use whatever number you want. We use 1,000 as a nice round number. You got the discipline putting that in a savings account. So even if they use that money in a savings account to put the down payments on properties 2, 3, and 4, they have over $200,000 in cash. Plus, they've got close to, how much is the total net worth there? They've got close to $500,000 in equity. So $200,000 cash, $500,000 in equity. Yeah, you got some more options there in a couple of years, don't you?
Yeah, you do. And of course, he has his duplex that he bought in 2010, where he has well into the six figures of equity in that, because, you know, he bought when everybody else was scared to buy, and he lived there and lived next to his tenant. He only needs to do this like one more time, and I think he's done. I'm not sure, actually. I can't remember if he was talking about doing it 1 or 2 more times, but it might just be one more time.
Yeah, I mean, and we don't even have the numbers from that first duplex we bought, because I mean, those numbers would really juice this up, because that was the perfect time to buy. But you know what? We want to answer that question. Those people out there, oh, am I too late to the game?
Right.
Does it still make sense to buy real estate? And I mean, this shows the numbers can still work. And this is on the more extreme side of the house hack. Like I said, some people don't want to live in the basement. That's fine. But you can buy other properties. You just won't cash flow as much. But if you believe real estate, if you believe Denver is going to be going up in price over the next 20 or 30 years, well, in the big picture, long point of view of things, it can make a lot of sense.
Mm-hmm. Yep.
So
that's why people do it.
Yeah. And so if you guys want to sit down and talk about this, like we just actually met with someone yesterday, very nice lady, used to live investing, now wants to get back into it. And we're just discussing some strategies. And she said, oh, well, I thought even for buying for an owner-occupied house, you have to put 20% down. Mm-hmm. And we said, no, you have to put, you can put 3.5%, 5% down. And just like we ran you through the numbers on the spreadsheet, we ran it through really quick. And she got really interested in house hacking. So if these numbers sound, really nice to you, like, hey, you can buy a good asset for $15,000, $20,000. So, it's still a good chunk of money, but it's not $50,000 down or $60,000 down. And you're willing to move around a few times, maybe live with roommates, live with tenants. Definitely either, watch a previous webinar, come to a class, call me or Charles. We can run you down through it, but definitely put house hacking on your radar. Any other comments, Charles, before we...
I think we hit it good.
Yeah. So we are going to go on to the next property. Yes, this property. And so, Charles, this is a deal that you are quarterbacking. What is it? What's the rundown?
So this is a property in Aurora South. It's actually very similar. I think it's essentially the same exact footprint as a property that one of our folks bought a year ago. And it's a solid cash flow property as it is, but it also has the opportunity to put in a 4th bedroom and also a 3rd bath if the buyer chooses to. So the buyer is a really experienced investor in town, not even quite sure what he's going to do. But what we wanted to make sure is that even as the existing 3.2, it's a solid, basically like a 7 cap. We talk about cap rates a lot. It's a 7 cap property that makes sense, but we think we can juice it up about $1,500. No, I take it back. I think it's going to be something like, I'm trying to think about the walls, probably about $3,500 or so to set up the 4th bedroom. It has an egress window already, but that would get it to a 4 bedroom, taking the rent up probably up a couple $100, which is most likely what he's going to want to do. And if he puts in a bath, it would be probably another $6,000-7,000 as well. And he might do that as well. But it's just a good example of that there are still properties that we can buy. Now, I'll tell you, 3 years ago, we were finding a dozen properties like this on the market that we could go and look at and make these kind of 7.5 cap rates. Right now, they are much harder to find. They truly, legitimately are, because the prices have continued to rise and the rents have started to taper off. But we want to give you an example of a property, and we'll go through the numbers and show you that it is still doable, and we are still closing these deals. It's just, frankly, not as many as it was a year, 2, 3 years ago.
And so now this is an investment property, not an owner occupied. So got to put 20% down to buy it. And so what the list price was like 230, right, Charles?
Right, call it right around 230.
Yeah. So just rounding up there. Interest rates 5.25 on a 30-year fixed. So the monthly rental, like $1,800 a month.
Yeah, we feel pretty confident with that. I have a bunch of units in this part of the world, and we're getting a solid $1,800. Section 8 is what I do a lot of. I'm not sure if this tenant will do Section 8 or not. My guess is he will, because I do think he has with his other properties. So we feel quite comfortable as a 3-bedroom. $1,800 should work. Gonna guess something like $1,950, $2,000 as a 4-bedroom.
And taxes are about $870 a year. Insurance, $300, not that much since an attached property. Repairs and maintenance, it defaults to 5% of the annual rents, so about $800. And the HOA, wow, $2,100 a year.
I think it's like $160 a month or $175. Yeah, that's one of the things we really like about it.
Wow, do they not like cover half the roof or something for HOA? That sounds like good.
Yeah, it's good.
Yeah,
it's been great.
So we're going to run these numbers, assuming not putting in the few $1,000s for the wall and not getting that additional rent.
Right.
So these are based on as is, buys it, close on, puts it up for rent.
Yep.
So going to the next tab in the spreadsheet, it's about a total cash flow of about $4,200 a year, 8% cash on cash return, and a 7.2 cap.
Yeah, it's really decent.
Yeah,
we really like this property. Yeah. And we just got under contract, 5 days ago, something like that. We did the inspection. Couple of things that we're going to ask for. Radon came in great. No problem with that. But we have a couple inspection items. But my guess is we're going to get through it.
So now I'm going to come back in here and plug these numbers in real time. Hopefully I won't screw up while I'm talking and typing. So again, we're keeping the purchase price the same, the down payment the same. All we're doing is adding about $3,000 into initial repair costs.
If you would put $4,000, let's pad that a little bit and put $2,050 for the rent.
Okay, so we're putting $4,000 for initial repair costs.
Bring it down a little
and
bit.
$2,050. That's coming up from $1,800.
Yeah.
So all the other expenses stay the same, and now that goes to $7,000 a year in cash flow, 13% cash on cash, and a 8.4 cap rate.
Yeah, I mean, we like this, and it's exactly what we did almost precisely 1 year ago in this complex with the exact same unit. So it makes a lot of sense. It gives a few options, and it's what we're out hunting. And when we get one, we get it. And we're pretty happy. You
don't see many cap rates in the 7s, or in the 8s anymore. No, and just, on the tangent here, I mean, we're recording this on Tuesday. This past Saturday, 4 days ago, we took a bus tour down to Pueblo that you helped to coordinate, Charles. And, I'd never been to Pueblo, wanted to see what the investment scene was like. And according to the agent down that shows properties, we stayed to like the nicer sections of Pueblo, not really where you can buy houses for $60,000.
Yeah, not like luxurious, but, still very working class, but not kind of semi-scary.
And I mean, the cap rates, we didn't see cap rates, I don't think, in the
they were like
8.4s.
They were pushing 8.4. But the truth is, we brought 50 investors down. We worked with ICOR, and it was a great bus tour, and it gave us the opportunity to go check out this market. And there was a variety of opinions. My opinion was it was okay, but I wasn't overly excited about it. Had I been overly excited, we actually would be maybe doing more there. But some of the investors definitely said they wanted to go down, maybe do some fix and flips, maybe some buy and holds. Maybe there's going to be an upward push in the prices, and there has been. The Pueblo market is actually quite strong now. But personally, we both felt like, it's pretty good. But, it's also a couple hours away, and we're not going to be going out of our way to spend too much time down there at the moment based on what we've seen so far.
Yeah, but it's still on my radar. I'm like, hey, if you can still, by hunting and doing some deals, you can still find really good cap rates in Denver. I lost my train of thought. Yeah, I mean, and I forgot what I was going to say about that tour, but it was good. If you guys get the chance to go down there, and I will be writing a blog post about it shortly. But can you spend a few more minutes, Charles, just kind of give an overview about what we saw, what type of properties we saw, and some basic cap rates? Because I know Charles and Lon both went down there, and while Charles was talking, Lon was running some quick cap rate numbers. So it was really interesting. You guys had some interesting analysis for some properties.
Yeah. So what we wanted to do was look at what we considered were were normal properties that an investor would buy. We didn't want to honestly find the world's perfect deal because we were trying to teach 50 people what this market was about. So we looked at reasonable properties. Think Aurora North types of environments, where I've owned properties for literally 20 years. I was very comfortable there. Generally blue collar, kind of working class ish, older homes, 1940s and 50s, that kind of stuff. Very mixed, some fixed up nice and some not. And what we saw is the caps were in the maybe low 7s to mid 8s. But I remember one had a cap in the mid to high 8s, but it was sort of leaning over. You remember that one with the floor that was about 2 inches off that had that nice basement?
Yes.
So, like I said, yes, there is cash flow there, but I didn't find it so extraordinary that I want to go back there. We did see a 12 unit that made a lot of sense that I think I know one of our folks has already put an offer in, and that one did make sense. So well worth that person's time. But this is what we like to do. We like to investigate markets and see what we think so that we can report back to you and hopefully give you some ideas on what we want to do, what you want to do, and see if we can help you out in doing this.
Yeah, I know there's some talk about maybe doing some more bus tours to other markets like Fort Morgan or
Greeley, Colorado Springs might be the next one. Yeah.
So if you guys see it, this is not, we're not involved in the planning. It's done through ICOR, which is a real estate investing club, but they put on good events. So we will, keep you guys updated and pass along. And they're, I think it was $75, $100 to go on the tour.
Yeah.
Like it's, for a day, like it's worth it.
And we did pick the property. So it was my agents and my investors in Pueblo who've done it for many years. So we were able to give, we spent about an hour talking about the market, answering lots of questions. It was a really, really good time. My only takeaway was I'm not going down there tomorrow because there was nothing that I particularly want to see tomorrow.
Yeah, I agree. But it's definitely on my long-term radar. Just, hey, you know what? It's 2 hours away versus 2 states away in some instances. Mm-hmm. But I found it incredibly just eye-opening. So if you guys get a chance to go on a future tour, consider it. It's cool. Mm-hmm. All right, so wrapping up here on the deals. So this is a new thing we're doing, Charles. We are taking over a meetup group called the Denver Real Estate Investment Strategies Meetup. And this came from your colleagues. So what's the background of the meetup and what we're doing with it?
So Matt Pillmore, who has VIP Financial, very, very successful businessman and guy who's built this great company called VIP Financial. He started this meetup, just a really, really good way for him to network with people. And what he's found is he's extraordinarily busy and didn't really want to maintain it anymore and has just not done much. So he said, look, guys, would you take this over, and let's just continue working with these people. So he'll be our, guest star and he'll still be a part of it. But we said, great, we just love to meet more people and taking over this Denver real estate investment strategies meetup. And we're actually having a class tonight. We'll get to meet a lot of the folks from the meetup who will be coming literally to our office in about an hour for an advanced real estate investing class.
Yeah. And so we'll be posting these to the, meetup.com page. If you're not familiar with it, that is a very successful website about just having local events where people can network and come together for, from business to fun stuff, to hiking, to travel, to everything under the sun. They have meetups for. So we'll still you can go there. We'll also still keep posting to the Your Castle trading calendar, to our trading calendar on Denver Investment Real Estate. So, don't worry about having to go to meetup. We will have it still posted everywhere. Bottom line, if you see a class you want to, just show up, come to it. We want people to come no matter what. So a couple of upcoming events. So Charles just mentioned a class that starts in about an hour as we're recording this, and that's his advanced real estate investing class. So he's got one on tonight, August 7th from 6 to 9. And next one scheduled is September 19th, which is a Wednesday from 1 to 4. Now, I know a lot of people listen to the recording of this and you're in the future, and Charles teaches a class, about once a month or every other month?
Yeah, maybe 5 weeks, something like that.
Yeah, there's no set in stone schedule, but I always like to mention it because here's the thing, this will be my 5th time going to the class. And I'm not just going to the class to support Charles. He does not need that. But because every time I go to the class, I learn something new. And the data that Charles covers in there and some of the discussion that comes up in the class, it's probably the thing that's influenced my own investing strategy the most. And if I had to say, hey, 3 hours, this one piece influenced me the most, it's the stuff I learned from Charles in this class, because it really just goes through different scenarios on, how to invest, and do you want to, what's the sweet spot in leveraging? Do you want to sell? Do you want 1031? Do you cash and refinance? Do you just hold the property and pay it off? So it runs through all these scenarios, and most of these scenarios are based in Denver, based on real deals that, Charles has been a part of or helped kind of other people put together. And it's just incredibly interesting data. So if you guys get the chance to come to it, it's free. And I feel confident to say it will be the best 3 hours you can spend to learn about real estate investing. So a couple other classes we're doing. The book we talked about earlier, The Practical Guide to Colorado Real Estate Investing. We're actually doing called a book launch, or book club, on Tuesday, September 11th. And this is just, idea that we've talked about for a while is, the content in this book is just, it's really good. Like it's solid content. And, we got just tons of stuff to talk about in here. And you had to say about doing a book club, right, Charles?
Yeah, I just want to get this in front of people. We spent a lot of time putting this together, and we've edited it over the years and edited it. And we're very proud of it. And if you're looking to get into real estate or want to hone your skills down, it's worth reading the book. So we thought, hey, let's sit for 2 hours and let me at least go through a high level of the chapters and tell you this is what you're going to learn here, answer some questions. So yeah, we're going to be doing that on September 11th.
And we teach classes. We talked about house hacking earlier. We're teaching class actually that same day. We're teaching the practical guide, the book launch. That is September 11th. And we teach house hacking class once every 6 weeks, 8 weeks or so. So again, if you listen to the recording and you're interested in house hacking after hearing about the numbers we talked about 20 minutes ago, just check one of the calendars. Be on the lookout for a house hacking class taught by us or taught by like Joe Massey and Travis Green, who are with Castle and Cook. Drop in, come there. We'll run through numbers on recent properties and go into some different scenarios on how to house hack. All right, so we will go and wrap things up. So everyone, thank you for coming out. Thank you for listening. And Charles, thank you for your time today. I know you got a busy night ahead.
Yep, we got a class to teach tonight. Thank you.
Thanks, everyone.
Bye.